Okay, so I hope you're all doing all right. This is the next lecture about international finance. And the single biggest important theme of this lecture is that international finance really is about finances, also sometimes called open economy macroeconomics. But what happens in terms of trade is really driven by where people want to put their financial investments, what they want their portfolio to consist of between uh, domestic assets and foreign assets, and that's not at all obvious to most people. This is one of the things that people who haven't had it taught very carefully in an economics class are very unlikely to realize that the trade balance, whether we have a trade deficit or a trade surplus, has to do with these flows of money, flows of funds. All right, so this is just what I was saying. Internationally, financial flows determine the flows of goods and services. This is the key fact. Open economy macro and international finance are two names for the same thing because of this. Okay, now I want to distinguish several things, and we've got this is also the sections of the next few slides. There's an accounting identity that says net capital outflow, here just CF for capital flow, is equal to net exports. That's true because of the accounting, but there's also an economic principle that intended capital flow determines net exports. Now, that it's not, the net exports determining capital flow, it's the capital flow determining the net exports. And the other thing that will happen in this lecture is we'll lay out the long run international finance graphs and the short run international finance graphs. Okay, let's talk about the accounting identity first, that net capital outflow equals net exports. From an accounting point of view, the easiest way to track international capital flows is to track the equal and opposite flow of IOUs. So IOU is actually comes from the English words, I, like me, and then OWE, and then YOU. So IOWE YOU, of course, gets shortened IOU, and probably most of you know that, but I think a few of you might not. So the idea of tracking international capital flows by tracking the equal and opposite flow of IOUs has a nice analogy to electric current. Electric current, in fact, has a lot to do with the flow of electrons, but electrons have a negative charge. And so the way on a diagram you would show the flow of electric current, it would be going the opposite direction of the flow of electrons. Similarly, capital flows goes the opposite direction of the flow of IOUs. So here's a picture here. If IOUs are going left, the international capital flow is going right. Let's make this more specific. What counts as an IOU? Certainly a bond certificate, a stock certificate. A bond certificate says this company needs to pay you back. A stock certificate says, well, you're owed the whole company beyond what's owed to the bond holders. Federal Reserve notes, namely those green pieces of paper in your wallet, are actually technically IOUs that says the government owes you something. It's a little undefined what the government owes you because of these green pieces of paper, but nevertheless, they're technically IOUs from the government. In the olden days, the government owed you silver or gold. But nowadays, it's a little unclear what they owe you, but those green pieces of paper do say that the government owes you something or other. you also have the electronic equivalents of bond certificates, stock certificates, and money. Another type of IOU is a deed of ownership to an office building or a factory. It says you are owed a factory or an office building. Okay. So why are international capital flows counted as going opposite the flow of IOUs? Let me get that out of the way. Well, first of all, whoever received the IOU gave up something for that IOU. If that something was another type of IOU, then the flow of IOUs nets out and there's no capital flow. If that something was something more tangible, that something is the capital flow. So, if they gave you funds to build a factory, then there's, or then you end up with that factory there, and they gave up. Boy, now I'm getting all confused, but let me keep going. Okay, so here's a picture that explains it reasonably well. So you've got these IOUs here, and there's this notion that that the international capital flow is like these tendrils of ownership. So you can see this plant here. So imagine the tendrils of ownership going out when the IOUs are coming the other direction. Okay. Anyway, the metaphor is also the flow, the flow of resources going to the right and the IOUs going to the left. Now, let's talk about why the accounting identity holds in the cases of purchases of foreign goods and assets, and then we'll talk about stock purchases. So we'll talk first about how the identity works, how the accounting identity works in terms of purchases, and then how it works in terms of not purchases of goods and services, but of stocks. But here we've got a purchase of goods and services, actually goods. So these are, you can see some of my musical tastes here. So I like Helene Fischer, Helene Fischer, I guess in German. And one of the things that's interesting about buying these is I bought electronic version. So I push a button and suddenly German GDP goes up without necessarily any human intervening other than me who's doing the purchase. At any rate, their US net exports are negative because there's music, there's these musical albums, even though they're in electronic form, flowing to the US. And then I send dollars to Germany. Now, these dollars count as IOUs, so there must be an international capital flow in the opposite direction. And you notice, okay, a bit ago I was getting a bit confused, but there's these substantial things flowing towards the US. So they're giving something genuine here, music, and I'm just giving them the electronic equivalent of pieces of paper. And so the international capital flow is that way. Okay, to the left. Now let's talk about purchasing stock. In this case, and this is something I do too. I might go to my retirement accounts and say I want to increase the amount of international stock that I hold. So now I would actually get a diversified portfolio of international stock, a mutual fund of many international stocks. But let's imagine for the moment that I was buying Lufthansa stock. That's a German airline company. And so I send dollars to Germany and they send me a stock certificate. But the stock certificate, like the dollars, is also an IOU. So you've got IOUs going in both directions. They net out. There's no net capital outflow. And also notice these are all just the electronic equivalent of pieces of paper. There's no net exports. Okay, so that's that. You can see how all the accounting works out. So now that's all just accounting. Now let's turn to the economic principle that intended capital flow determines net exports. And this principle makes it so that we're not done with the stories we've just told. So the currency flow caused initially by purchases of foreign goods and services, those currency flows are soon canceled out by currency flows in the opposite direction, leading ultimately to no net capital flow. And the currency flows caused initially by purchases of foreign assets are soon canceled out by currency flows, those dollar flows I showed, in the opposite direction, leaving the flow of ownership certificates for foreign assets as the only flow of IOUs. In the end, this means there's a capital flow opposite the flow of ownership certificates for foreign assets. In any case, what's going on is you have this principle of the recycling of dollars or domestic currency. Where people really want dollars are back in the United States, and so the dollars tend to make their way back, and then you have whatever else happened remaining. Let's get more specific here. So anyway, this is a bit of an incomprehensible slide, but it tells you the story's not done. Let me give you some pictures. Okay, so you have a purchase of foreign goods and services. There was no intentional capital flow. It's not like somebody wanted a different portfolio, but we did have a capital flow because there were dollars flowing to Germany. But those dollars are unwanted in Germany. I mean, folks in Germany want euros. They'd be happy with a big pile of euros. They're not so happy with a big pile of dollars. Maybe they want some dollars, but there's a certain amount of dollars they want, and they don't really want dollars beyond that. So if you give them dollars that are additional, they'll say, wow, I don't really want them. What's got to happen? Well, the price system comes into play. The exchange rate adjusts to whatever it takes to get those dollars back to the United States where people want them. Notice an individual in Germany could say, oh, I don't want these dollars. I'll go to the bank and exchange them for euros. But now the bank has more dollars than it wants. And so they're a hot potato in Europe. These dollars keep going around and around in Europe. And if there's a surplus of dollars in Europe, that will drive down the value of dollars. And as the value of dollars gets driven down, then US goods look cheaper. So there'd be more exports from the US also. You know, foreign goods look cheaper in the US, so there's less imports. But I've drawn this fairly simply as the surplus of dollars in Germany made the dollars cheap, and the folks in Germany bought some apples in this picture. So now what happens in the end? After the exchange rate, part of the price system, comes into play, you get the dollar flows canceling out. The dollars come back home where they're wanted instead of staying where they're unwanted in Germany. And we have the dollars, no net flow of dollars in the end, but we have music going left and apples going right. Music coming to the US, apples going to Germany. And so there's no net exports. The music is balanced out by the apples, no capital outflow, no net exports. These purchases of goods leave no change in either. All right, now and this is what I just said. If you, say, okay, I'm not so interested in that part of the story where the dollars took a brief sojourn abroad and then came back. This is what I have is music being exchanged for apples, or apples being exchanged for music, either way you want to see it. Now let's talk about the purchase of foreign assets. This is an intended capital flow. The starting point is US dollars get exchanged for Lufthansa stock. But again, those dollars pile up in Germany and they're not really wanted there. They want euros, not dollars. They go to the bank and say, give me euros, but now the bank has dollars. So these dollars kick around in Europe as a hot potato for a while that nobody really wants. Then the price system comes into play, makes those dollars a little cheaper, and they get recycled back to the United States. How do they get recycled? Well, by buying U.S. goods and services, or you could have folks in the U.S. importing less. But let's take the simpler story that they're used to buy U.S. goods and services. In this case, you've got a picture of apples. Now the dollar flows net out, and what do we have left? We've got dollars going. We've got apples going to Germany, and Lufthansa stock going to the United States. Now, how are we doing in terms of capital flow and net exports? Well, the U.S. net capital outflow is positive. You can see that both because substantive things are going to Germany, but more easily, you could just see the IOUs are going to the US, so there must be a capital flow to Germany. And indeed, I wanted to send my investable funds to Germany to invest in a German company. And the fact that I'm investing in a German company, which is a capital flow going to Germany, is shown by the fact that I get a stock certificate from Germany. So we've got a positive net capital outflow, and that is matched by a positive change to US net exports. Obviously, I'm talking about the change rather than whatever level of net exports or net capital outflow there was before I did this transaction. Okay, so now we've talked about the accounting and the accounting and also the real world forces, or not the real world forces, but the economic forces. So I hope you see that when I had an intentional capital outflow, that caused net exports to go up. Namely, I wanted to buy stock, that caused the apples to go. But when I wanted goods, I didn't want a capital flow, then yeah, it did make apples go to Germany here, but it didn't cause any change in net exports. We've got, exports and imports are both going up and no change on net. Okay, let's look at the graphs now. So, and I'll go through them one by one. So they're quite complex, and I'll do another lecture where I'll use the giant Post-it notes to talk about this. But let's get a start on getting used to these graphs. So, so this is the market for loanable funds when there's an open economy. So you've got the supply of loanable funds, which is also the supply of, which is also the amount of savings. So it's kind of convenient that S for supply of loanable funds can also be S for saving, either way. But supply of loanable funds. But the other curve has to be called the demand for loanable funds. Now, how do these depend on the interest rate? Well, I've drawn the supply of loanable funds from saving as going up with the interest rate. If the incentive effect of the interest rate were the biggest thing, then a higher interest rate would make people save more. There's also a wealth effect, so it's complex, but nothing. You can still do the analysis if the supply of loanable funds is vertical, or even if it's slightly backward bending, as long as it's not as backward bending as the demand for loanable funds. But in this course, I'm always going to assume that the supply of loanable funds from saving is upward sloping, that supply of loanable funds goes up with the interest rate, unless I tell you differently. And I don't know that I need to be as ambitious to do the other cases. So go ahead and, unless I tell you differently, assume that the supply of loanable funds increases with the interest rate, And but know that that doesn't necessarily have to be true. And you know, some of you might find it entertaining to analyze what will happen if the supply of loanable funds is vertical or slightly backward sloping. Okay, now this demand for loanable funds is really just the sum of investment demand and the demand for funds to send abroad as a net capital outflow. This CF is net capital outflow, and CF stands for capital flow. But remember that if you say it more fully, that's net capital outflow. So we'll show those graphs individually, but this demand for loanable funds is the sum of those two graphs, the sum of the demand for investment and the sum of the demand for loanable funds for the purposes of investment in the U.S. or other the domestic country more generally, plus the demand for loanable funds to send abroad. And we're definitely saying that a lower interest rate will increase the demand for loanable funds. Why? Because a lower interest rate makes people want to invest more, and because a lower interest rate means, wow, you're getting a puny return on investment in the US, why not send it abroad where you can get a better return? And of course, the position of this graph is holding fixed what kind of return you can get abroad. So we'll talk about that again when we get to the individual curves. Now, that's in the long run. As I've tried to emphasize before, but can't be emphasized too much, the supply and demand for loanable funds is a long run graph. It is not useful in the short run. I think there are professors or other instructors of macroeconomics classes who do not get this right. But that supply and demand for loanable funds is a long run graph. What happens in the short run? Well, in the short run, the interest rate is simply determined by the central bank, the Fed or other central bank. And as we've talked about, that's basically, it's useful to view it as just determined by the supply and demand for the monetary base. The one change here is I've now put the real interest rate on the vertical axis as opposed to the nominal interest rate. That's not a big change, but it is an important one. You know, it's just we care about the real interest rate for these graphs, so I've put the real interest rate on the axis. But that's just, you know, for any given rate of inflation, that's just a bit of an up or down shift in this. For positive inflation, the real interest rate is lower than the nominal interest rate. Okay, but a lot of times it's not worth even drawing the supply and demand for the monetary base. We can just instead say, oh, the central bank, the Fed or other central banks simply decides on the real interest rate. And, you know, how is it deciding the real interest rate? Well, it determines the nominal interest rate, and inflation has a lot of inertia to it. So given a level of inflation, which doesn't change super fast, the nominal interest rate determines the real interest rate by the equation real interest rate equals nominal interest rate minus inflation. Okay, so that's the short. So to recap, in the long run, international finance diagram with 4 different graphs in the end, I'll show you more in a minute. You have this market for loanable funds, but in the short run international finance diagram, you don't have the market for loanable funds. Instead, you have just an interest rate, or if you want to put more detail, an interest rate determined by supply and demand for the monetary base. But typically, we don't need to go all the way back to supply and demand for the monetary base. We can simply say that the central bank chooses the real interest rate. Okay, now some of the other graphs here. What's going on here? The claim in this picture is that a lower real interest rate will raise the capital outflow. And that's for the reason I said before. If the real interest rate is low, that means returns are miserable in the US, and you'd rather try to get a higher rate of return abroad. So suppose that returns in the US were minus 4% in real terms. That's a pretty low rate of return. You might well hope to do better abroad. And this graph is holding fixed what you can do abroad. So the worse you can get in terms of rate of return in the US, the more you're tempted to send your funds abroad. Okay, what's going on here? This is the typical dependence of investment on the real interest rate. What's going on is if you have to pay a lot of money in interest rate, only really good projects look attractive. There are only so many really good projects, so you only have so much investment. But on the other hand, if the real interest rate is really low, you don't have to pay very much to borrow money. You can issue bonds, borrow money in other ways, and you don't have to pay much interest. So if you don't have to pay much interest, there are a lot more projects that look attractive. So fundamentally, this graph comes from the heterogeneity of potential investment projects. One of the interesting things to note is that in the formal models that economists use, they actually typically simplify by not having heterogeneous investment projects, but that's what you need to make sense of this graph. You have very different investment projects, ones that are worth doing even at a very high interest rate, other investment projects that are only worth doing at a low interest rate. Therefore, more investment projects pass the test at a low interest rate, and therefore investment is higher at a lower interest rate. Okay, now another graph, the fourth graph that comes into play, let me try to explain this. We already talked about net exports as a function of the real exchange rate. You know, if the real exchange rate is low, that means the dollar is cheap, and so there's more exports from the US. It also means, you know, to people in the US, yen and euro and pounds look expensive, so we import less. And so the net exports are higher when the dollar is low. When the dollar is high, you have fewer net exports. So this NX of E curve should be a little familiar from the previous lecture. But the new thing is to realize that net exports as a function of the real exchange rate, that curve, and it's a curve because it's shown as a function, is also the demand for the dollars. So what do you want, you know, what do you want dollars for? You want dollars to buy stuff from the US, okay? So that's, that demand for dollars is the net exports. And we're treating the capital flow as a supply of dollars. Remember, when I bought the, you know, in the story, when I bought the Lufthansa stock, I'm supplying dollars to the folks in Europe. They may not really want them, but I'm handing them dollars that we're treating as the supply of dollars. And we're saying that the demand for dollars ultimately is just from net exports, which corresponds to the fact that the way we got those dollars back to the US was by, you know, sending apples to Germany. Okay, so now this capital flow, why does this look vertical? Notice it looked downward sloping here, but you've got the real interest rate on the axis, right? To say that capital flow goes up when the real interest rate goes down is one thing. What we're saying here is capital flow doesn't depend on the real exchange rate. And I can't believe I have a capital letter E instead of an epsilon. That should be epsilon there. I'm sorry about that. Okay. So So what are we saying? We're saying dollar high, dollar low. That doesn't affect people's investment decisions that much. And we could question this, and we could make a more complex model where we worried about the effect of the exchange rate on capital flows. I think that this is quite a good starting place, and so I think Mankiw is doing just fine by making this simplification that the capital flow doesn't depend on whether the U.S. dollar is high or low. One way to one thing to back this up and to think about is that if the US dollar is going to be high both now and in the future, if the real exchange rate is going to be the same in the future, then it doesn't really affect the rate of return you get on your investments once you make a round trip. So if the US dollar is high, then you get more euros, you can get more European stock, but by the time you want to get your money back in the US so you can spend it after earning some return, if the US dollar is high, you can't get as many dollars for the stock that you, the Lufthansa stock or the foreign stock that you ultimately sell. So if the real exchange rate stays the same over time, its level doesn't really affect the rate of return, because once you make a round trip, that cancels out. If people expected the real exchange rate to change, that would be a very different matter. That could affect the returns a lot. But we're simplifying by assuming people don't expect the real exchange rate to change by very much. And if they don't expect the real exchange rate to change by very much, then there shouldn't be there shouldn't be too big a dependence of the capital flow on the exchange rate. Okay, now, it was a little hard just looking at those one by one. I think in some ways it's easier to understand them when you have all four in the full diagram, which is a 4 graphs worth of diagram. Here's the long run international finance diagram. You've got the long run market for loanable funds. Again, market for loanable funds is a long run graph. It's not very useful in the short run. And it would be very weird in the short run if you tried to draw it at all. This demand for loanable funds is the horizontal sum of capital flow as a function of the real interest rate and investment as a function of the real interest rate. So this demand for loanable funds is really CF plus I of R, or CF of R plus I of R. It's really, and this demand for loanable funds is never allowed to move unless one or both of these other CF of R, I of R moves. So this is not, demand for loanable funds is not its own independent graph. It depends on these two. Supply of loanable funds is its own independent graph. It can move on its own. Now, once we've determined an interest rate here, that determines a quantity of capital flow. And that quantity of capital flow, right, given the interest rate, depends on the interest rate, but we've determined an interest rate that determines a quantity of capital flow. That quantity of capital flow gives us the supply of dollars, which does not depend on the real exchange rate, given our simplification. So this supply of dollars curve is also not an independent curve. It only gets to move when this intersection gives us a different quantity of capital flow. However, the demand for dollars, net exports as a function of the real exchange rate, that is an independent curve that can shift for a variety of reasons, which we'll give examples of later. Okay, now let's do some comparative statics exercises. Let's think of an investment tax credit. Well, the first thing that happens logically is that investment as a function of the real interest rate increases. you get a tax benefit for investment. Government's rebating some of the money that you paid on the investment goods. And so the investment as a function of the real interest rate shifts right. Okay, next thing we've got to say is, wait a minute, demand for loanable funds is the horizontal sum of investment, of the investment curve and the capital flow curve. So the demand for loanable funds must also shift right. Okay, that's this. This is happening because of this, right? Because the investment curve shifts, the demand for loanable funds shifts, and for no other reason. But with the same supply of loanable funds, that gives us a higher interest rate and a higher quantity of investment plus capital flow. Investment plus capital flow, that quantity is the quantity of loanable funds demanded. Okay, so the interest rate goes up. What does that do? Higher interest rate reduces the flow of capital out of the country, and that shifts this supply of dollars left. Not only interest rate went up, that was important, but with the quantity of capital flow going down, or then this, with the supply of dollars going down, dollars, not surprisingly, become more expensive. The exchange rate goes up. Okay, and I've neglected to draw the epsilon prime line, but it would be up a little bit higher. Okay, now here's a question about the short run. See if you can do the analysis. You again, for the short run, ditch the market for loanable funds. In place of the market for loanable funds, just look at the change in the interest rate that the central bank has decided on. The central bank, the Fed in this case, is raising the real interest rate. What happens to net exports and the real exchange rate in the short run? Stop the video and answer the question. Okay, so I think I'll have pictures for this a little bit later on, but let me just say how it works. The higher interest rate is going to reduce the capital outflow, and the capital outflow equals the quantity of net exports. So the net exports has to go down. Now, why is the capital outflow going down? It's because now, with the higher real interest rate, keeping your loanable funds in the US looks more attractive. You're getting a better rate of return in the US. So you don't want to ship as much abroad. Capital flow goes down. That has to make net exports go down. But of course, the net exports have to be driven down by the price system. The way you get the net exports to go down with the price system is to have the dollar go up, to have that real exchange rate increase. Okay, I think there'll be pictures of that later on. Okay, now here's another, let me do a couple more examples. So we've got this, suppose I change my 401k regulations to encourage people to hold more foreign assets. Like I say, oh, if you don't do anything, automatically some of your money that's being taken out of your paycheck every month to save for retirement will go into an international mutual fund. Well, if I do that, and this is a case where I'm imagining the total amount that's in the total amount that's being saved is staying the same, so no change in the saving curve. But of that amount being saved, more of it is going to foreign assets. So that's an outward shift in the capital flow curve as a function of the interest rate. That again shifts the demand for loanable funds out and raises the interest rate. But now we now we actually have, you know, it happens like it's shown in this picture, that the total quantity of capital flow increases, which drives down the exchange rate and drives up net exports. But if you look at this, it looks like it would be ambiguous. The capital flow curve is shifting out, but the interest rate's going up, which you could imagine you might wind up there. But in fact, this looks ambiguous, but it's unambiguous. And so I will both, when I do things on the giant Post-it notes, I'll both explain that more, and I'll also send you the link to a detailed explanation of why it's not ambiguous. Okay, so just to review, here are the four graphs for the long run international finance diagram. And in the short run, here's what it looks like. Or if I leave out the supply and demand for the monetary base, I just have differences in the interest rate. Here in this picture, I'm doing a stimulative monetary policy, which cuts the interest rate, raises the quantity of capital flow, and that shifts out the supply of dollars, which makes dollars cheaper and increases net exports. Anyway, I'll do a bunch more examples for this. You can see those slides, but I'll do that mainly on the giant Post-it notes. So anyway, I'll definitely take you through this a lot more. You're going to need a lot of practice with this, but that's a good place to stop for now. And thanks for listening, and stay safe.